Like it or not, Michael Saylor and Strategy, the company formerly known as MicroStrategy, is the biggest player in the Bitcoin industry, and that's having a cascading impact on a whole bunch of companies that I've invested in. Companies like Robinhood, Coinbase has fallen. A lot of companies that have any sort of exposure to the blockchain have dropped over the past couple of months, and that's in large part because Bitcoin itself is dropping. And MicroStrategy is at the center of that. Now, about a year ago, you can see here, I did a video explaining what Bitcoin yield is. Bitcoin yield is what MicroStrategy has been using to increase the amount of Bitcoin held per share. But this is a really risky strategy because it only works until the moment it doesn't. And Bitcoin itself doesn't actually fundamentally generate any value. There's no dividends, there's no cash flow that's paid out. So what Saylor's doing with strategy and Bitcoin is sort of building a house of cards. And if that confidence in that house falls apart, everything kind of falls apart around it. So if the blockchain or crypto is an area that you're invested, you got to know what they're doing. And they gave what is, I think, a kind of a crazy presentation yesterday to investors. I'm going to dig through exactly what they said, because understanding the risks under the hood for strategy could tell us where Bitcoin is going to go in the future, especially if the market goes south in 2026. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And of course, subscribe to my newsletter, Asymmetric Investing. There's a link on the screen and a link in the show notes. Before we get too far, I do want to highlight this video that I put out a year ago. Shares of MicroStrategy were trading for $368.20. Now, I was calling into question their strategy. Shares are now at $188.01. Now, the risks are different today than they were then. Part of the risk then was that there was a premium that investors were paying for the stock compared to the net asset value of the Bitcoin that was held on the balance sheet. That's the arbitrage that strategy is trying to use to increase their Bitcoin yield or the amount of Bitcoin held per share. But the fundamental risks are bigger than ever. And that's because Bitcoin itself does not generate cash. And strategy has been using debt and preferred equity to buy Bitcoin. That debt and preferred equity has to pay out money, real money, not Bitcoin, but actual cash to pay off those dividends and the interest rate that is associated with that debt. That's why the presentation that they gave yesterday, this is from December 1st, is so interesting. Now, to just jump ahead, this is the image that was kind of going around the internet yesterday. This is where Saylor, I think, becomes kind of a wild man when it comes to investing in Bitcoin and his fervent belief in Bitcoin itself, because this is not the way a real business works. He's comparing Bitcoin to basically fueling a spaceship. I'm going to explain all these pieces here, but the real thing that you need to know is that they now had to raise US dollars, so sell stock to raise US dollars to pay off dividends. So first of all, let's go to their guidance. What they said is they expect Bitcoin to be $85,000 to $110,000 by the end of the year, and that their Bitcoin yield is going to be a little lower than their original projections. So again, that yield is how many Bitcoin per share, how much does that increase per year? If you go from 1 Bitcoin to 1.3 Bitcoins per share, that's what they're calling yield. That's not really yield, but that's how they're explaining it. But now to do that, they need to have Bitcoin in the balance sheet, and then they're going to either sell convertible debt, preferred equity, or stock. So their enterprise value is higher than their Bitcoin reserve. They see that as a good thing. That means that they're selling it at a bit of a premium, but you do have risk on the balance sheet, and that is this convertible debt and preferred equity. So that's a piece that I'm going to focus on today, because that's the reason that they raised $1.44 billion worth of cash. So here's that reserve to increase their credit worthiness is what they're saying. And their dividends per year on their preferred equity is $800 million. So dividend coverage, 1.8 times. Now, the challenge is if you're just holding Bitcoin and your Bitcoin is valued at the exact same as your equity, you're not able to issue equity and increase that yield, but you're still going to have to come up with this cash. This is just dividends. Then you also have the debt too. So let's go through all these pieces, because there's $16 billion worth of debt and preferred equity that is going to be sitting in front of line of you as a common shareholder in strategy stock. So basically, if Bitcoin falls, who's going to get the value? These people come first. The owners of debt and equity come first. So $8.2 billion worth of debt. Now, a few things that I want to highlight here, because some of these metrics are not real metrics. They're just strategy specific metrics. Bitcoin rating is basically how much Bitcoin do you have divided by the amount of debt. So they're saying they have 7.2 times the amount of debt. So that is saying that they can basically pay this off 7.2 times. That's also how you get to Bitcoin risk. So what they're using is a distribution. See, it's right here, number 2 on the bottom, probability of an instrument having Bitcoin rating less than 1 at the end of its duration using a log normal distribution modeling of Bitcoin price adjusted for Bitcoin ARR and Bitcoin volatility assumptions. If that sounds wild to you, it's because this isn't really how ratings and risks work. Prices don't move in a normal distribution. This is just not the way that you typically think about risk. But this is the piece of the stack that is going to come first. Next is going to be preferred equity. So in total, you have $8 billion worth of preferred equity. You can see they're adding these up here. So 6.2 is the coverage using Bitcoin of both the debt and strife, as they call it. And then you'll go all the way down here to all of their preferred equity. You have 3.7 times the coverage needed to pay that off. The remaining Bitcoin, if you sold all your Bitcoin, let's say that you were able to actually do that. I don't think you could do that in the public markets because there's just not that much demand. Remember, Strategy is the biggest buyer of Bitcoin, biggest net buyer of Bitcoin. So if they become the biggest net seller of Bitcoin, Bitcoin value is going to just drop like a rock. But the coverage right now, 3.7 times. The challenge is this right here. So they need USD funds to pay for their dividends. So right now, this $1.44 billion, they have 1.75 years worth of US dividends, 74 years of what they call Bitcoin dividends. So they need Bitcoin to increase by 1.4% to be able to just kind of maintain the business as it is today. Above a 1x net asset value, they're able to issue common stock and actually have more Bitcoin per share. So it's basically accretive. Below is when you really get to problems. So what are you going to do if that value drops below the net asset value? As of today, and I'm recording this on December 2nd, that actually fell below the 1x net asset value. Now you still have to pay off that debt. You have to pay dividends on preferred stock. So your options are you sell Bitcoin or you sell Bitcoin derivatives. This is where you get to this wild chart here. So Michael Saylor explicitly said, hey, you know what? If we have to, we'll sell Bitcoin. So there's a $50 billion per day Bitcoin market. We could sell 0.4 basis points of Bitcoin per day, which is a relatively small amount. And we would be able to fund these obligations over here. He would prefer to do this, to sell MicroStrategy stock and be able to have that be accretive to the business. What if things get really bad? Well, you could go to the derivatives market. You could sell options. You could sell futures. These are all things that he discussed on a call with investors as well. But they're holding $59 billion worth of Bitcoin. If the stock falls below that $59 billion number, if the enterprise value of the company falls below the net asset value of the Bitcoin held, that's when you fundamentally run into problems because everything that you're doing then becomes diluted because you have to pay these dividends and you have to eventually pay off this debt, $8.2 billion worth of debt. Now there's 2.5 years left on this debt. What happens in 2.5 years? That's really the fundamental question. Are they going to be able to raise more debt? Are they going to have to issue more preferred stock? This is not a small amount of money. And if the interest rate on this debt goes up, if you get to the point where you're starting to get to junk bond territory, where you have a 10, 11, 12% interest rate, that is hundreds of millions, potentially over $1 billion worth of cash that you're going to have to come up with every single year to pay yield on that debt. This is really the challenge for Strategy and for Bitcoin in general, because if Strategy as a company, Michael Saylor, becomes sellers of Bitcoin to fund their obligation, because they're not now trading for a premium of their net asset value of Bitcoin, they're trading for a discount. And typically that is the way that these funds work, is that you trade for a discount. Because if you want to buy Bitcoin, just go out and buy Bitcoin. You don't have to buy Strategy stock. But Strategy has to pay its debt. It has cash obligations, and Bitcoin itself does not spit off cash. And so this is the real problem for the company. If Bitcoin continues to fall, this could get significantly worse. Worst case scenario is you get to the point where this coverage ratio isn't 3.7, it's more like 1. Now you may really have to sell Bitcoin. That could be a cascading impact. So the reason that this is important for not just Strategy and Bitcoin itself, but it translates to a lot of other companies. I own shares of Coinbase. Coinbase has not had a particularly good year, and it is off kind of its all-time highs here. You can see that shares are down 436% or so. Robinhood is another one, down a little bit over the past few months because you've seen less crypto trading. As crypto drops in value, there's going to be less crypto trading. That's a huge revenue driver for Robinhood. This goes to other companies like SoFi. So lots of companies are going to be impacted, even if they aren't directly impacted by the price of Bitcoin or Strategy itself. Michael Saylor playing a very, very risky game with Bitcoin. And they proved that this week because they had to sell stock just to pay financing obligations. That is not what you want to see if you're a Strategy investor. And if the stock continues to be under that one net asset value, that's really a bad sign for strategy, and they could end up having to sell Bitcoin, which again, could be a cascading impact long-term. Let me know what you think about the future of Bitcoin and strategy. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.